It's common knowledge that the backbone of the United States of America is the Federal Reserve, the country's central bank. Through the years, the narrative of every major economic event has been penned by this institution in some capacity, and it will continue to be that way for the foreseeable future. In the past few months, news from the Federal Reserve has been dominating headlines all over the world. The US has recorded a once-in-a-generation inflation figure of a towering 7.5%, meaning that at this rate, all prices are going to be doubling every 10 years. Now, for a developed economy to be recording such an inflation figure is a big red flag. We've only begun the new year, and in just the first month, in January alone, the S&P 500 nosedived a monumental 10% amid the economic tremors that the world is experiencing today. When the hegemony senses fear, the effects trickle down to the rest of the world as well. We are living in a very delicate economic climate, a time in which the common man is slowly but surely beginning to lose faith in the ability of the government's institutions to resolve crises. At present, everyone's eyes are on the Federal Reserve to cure inflation. For a long time now, the United States has enjoyed a bull run in the stock market. For investors, it's been nothing less than a fairy tale where buying the dip ensures guaranteed returns. However, amid this pandemonium, there have been individuals who have observed the market without the fluff. People who have been able to see through the smoke and mirrors, and their findings are worrying to say the least. Among these experts is Mohammed El-Erian, one of the most sound voices in the financial world. He currently serves as the president of Queen's College, the University of Cambridge, and since 2014 he's served as chief economic advisor at Allianz, the corporate parent of PIMCO, where he formerly served as chief executive and co-chief investment officer. He is one of the more outspoken voices in the media and on social media when it comes to sharing his opinion on topics like finance, government policy, and economics. In a recent interview with Bloomberg, Mohammed bluntly stated that it's high time the Federal Reserve got bold. So let's see what he has to say.
Of the words with significant action.
And significant action means what? This is the interesting question. A good friend of ours, Mohammed, Bob Michael at JP Morgan Asset Management, had this to say a little bit earlier on this week. I want to share with you his comments and then get your response to it. Take a listen.
It's frankly too late for the Fed to engineer a soft landing. They now have to focus on getting inflation back down. We're going to see a Fed funds rate that's going to get to 3% minimum in this cycle. And by the way, it's not so preposterous to get to that level. We got to 2.25%, 2.5% back in 2018.
Final word here, Mohammed. 3% minimum. Your response?
That's ambitious because it may break something. John, where Bob is absolutely right, they are starting late. They're starting very late, and therefore the window for an orderly normalization is quite small. So they've got to get it absolutely right, and that means they've got to be bold come January and March, not just March.
Come next week. So let's go there. How bold do you think they need to be next week? What do you think they need to do?
They've got to immediately stop QE. They've got to stop QE at that meeting. They've got to announce that come March, we're going to have the plan for QT, and they've got to socialize quickly the expectations of at least 2 to 3 hikes. And, John, really important, explain to us why you got the inflation call so wrong and why you stuck with transitory when a lot of people had moved on from that. Unless they do that, restoring the credibility of monetary policy is going to take a long time.
Is that a need or an expectation for next week, Mohammed?
So that is what I think they should do. My expectation is that they're not going to do that.
According to him, the United States would be walking on a thin line for at least the next couple of years. Mohammed recently tweeted, "The last thing you'd expect is no Fed action." At present, inflation is at its worst level in 40 years. The economy is struggling to get back on its feet post-pandemic, and a labor shortage and persisting supply chain bottlenecks are wreaking havoc on consumer pricing. The Federal Reserve's ultra-loose monetary policy has boosted asset prices over the last 2 years, so the potential of tightening has frightened investors in some of the areas that have benefited the most, like in equities and cryptocurrency. In an opinion piece with Bloomberg, Mohammed criticizes the central bank, claiming that their agenda all along has been to please financial markets at the cost of increasing the challenges ahead for the economy, sound policymaking, and its credibility. It's on record that for the better part of 2 years, Mohammed's perspective on the US economy has been extremely bearish, no thanks to inflation and lax monetary policy. However, if Jerome Powell, the chief of the Federal Reserve, can make a public statement about inflation being transitory, I'm not surprised that experts like Mohammed are beginning to question the credibility of one of the most powerful regulatory bodies in the world. Now, if you're like me, you value your privacy and your freedom, then you need to hear about this video's sponsor, Atlas VPN. They are a provider of VPNs, virtual private networks, which can help to stop your data from being spied upon by your internet service provider or any unwanted eyes. Atlas VPN can help you disguise your traffic to make it seem like you're somewhere you're not. You can pick from tons of different servers and countries. This can be great to access those websites that might be blocked in your country from the government or from any geo-restriction laws. By using a VPN, you can really easily get around those bans and visit whichever sites you like regardless of where you are. Or you can just use Atlas VPN to watch Netflix from another country. Say you heard that The Office is on the UK Netflix but it's not on yours. Well, you just very simply select the UK, the VPN then makes it appear as though that's where you are, and just like that, you can watch The Office without having to go on some dodgy streaming site. Atlas VPN is one of the best known and most trusted providers out there, and if you're considering using a VPN at all, then I highly suggest you click the special link in the description and get access to Atlas VPN's special deal with 82% off. Now, El-Erian is certain that the Federal Reserve's actions are going to lead the country down one of two paths. The first one is not quite so dispiriting. Although interest rate hikes have been long ignored, it's better late than never. If the Federal Reserve is fast to act and executes quantitative tightening and interest rate hikes in a planned and phased manner, he says we can expect a healthy correction in the economy by the end of 2022. By the looks of it though, that correction has already started. The second path is slightly less optimistic, where the Federal Reserve fails to achieve what it initially set out to with inflation. In coming months, if they realize the situation has gone out of hand, they will most definitely hit the brakes hard. Sudden interest rate spikes and quantitative tightening will spook investors as consumer balance sheets get run down, leading to another economic recession. That being said, things are not always as straightforward as they seem. Let's be honest, this isn't the first time America and the Federal Reserve alike have found themselves in this sort of scenario. And when it comes to the fine art of bringing an economy back to equilibrium, the scales always shift and somebody has to take the fall for it. Over the years, mainstream media has conditioned us to believe that the amazing bull run that the US has witnessed for so long is due to the boom of innovation and enhanced productivity, and there is some credence to that idea, but there is more to this than meets the eye. Every time a country is hit by an economic crisis, the central bank has come to the rescue. We've seen this during every major financial downturn since the dot-com bubble and the 2008 housing crisis. From bailouts to quantitative easing to interest rate manipulation, the central bank truly holds the reins of the country's growth. Over the past 2 decades, investors have started to notice that whenever the market turns bearish because of economic instability, there is a surefire way to make money. I am of course talking about the buy the dip mentality, wherein investors recklessly shove money into the markets without any analysis and have faith that the market will be back to the same or higher levels in no time. But this is the stock market, not sorcery. Every asset price is fueled by maths derived from supply and demand. Every time the US is hit with a crisis and the market falls, the Federal Reserve induces more liquidity to artificially stabilize that crisis. The increased money supply resurrects asset purchases and brings about a rally in the market. The money supply is so huge right now because of quantitative easing that basically allows private equity firms, hedge funds and other large institutions to borrow money for free because of near zero interest rates. Debt has become a laughingstock, but that is a topic for another day. As I said, everything is about striking a balance. Nothing comes for free. The result of this continuous pumping of money is inflation, and there is going to emerge a class of people who invested their money into the dips, and they will be in for a rude awakening. At present, the US is faced with monumental geopolitical issues, with Ukraine, which has engulfed the country with doubt and fear, which needs to be dealt with at a government level, and on the other hand, we have sky-high inflation, which comes under the purview of the Federal Reserve. What I'm hinting at is that once the Federal Reserve starts the rate hikes, investors who blindly bought the dips without any understanding of what's really going on are going to suddenly feel abandoned because the markets will not react as they used to when quantitative easing and zero interest rates were the norm. In short, the Federal Reserve will ruthlessly cull investors to cure inflation. Let's make one thing clear though. This is not uncommon. Some people might find it counterintuitive that a government entity takes steps to make people less rich, but that's not true. They must maintain equilibrium for a healthy economy. Now here, Mohammed explains this better than I ever could.
There is this view that people who do not advocate for low interest rates they also don't advocate for full employment, for the recovery from the weakest in society. Just this idea that you need to stay down here to allow things to burn hot, to have a more inclusive recovery. You push back against that. Can you walk us through it and why it's dangerous to maintain this belief that you have to advocate for zero interest rates to be able to advocate for full employment?
Yeah, John, I think what people don't realize is that the environment matters. So if as we were in the past, in a globally disinflationary environment, which we were, then you could stay loose for longer and try to raise everybody's living standards. And that made sense, and I was actually supportive of that. What doesn't work is when you have a global inflationary environment and you try to do that, because ultimately what you're going to do is hit the most disadvantaged segments of the populations in two ways. First, by inflation, and there are studies now that show, I think beyond any doubt, that inflation hits the poor the most. And we hear it already with what's happening to food price, to gas prices. And then secondly, after they've been hit by inflation in a bigger way, they get hit by declining economic activity and losing jobs or losing wages. So you don't want that to happen. You don't want to hit them twice. And that's what I'm afraid is a high risk right now.
So help me understand then, and help our audience understand, Mohammed, if they start to hike interest rates, if they start to reduce the balance sheet, how that helps. What does that achieve?
So it achieves a sustainable path. You know, there's an old phrase that macro stability isn't everything, but without macro stability, you have very little. So macro stability is a necessary condition. And I've always said that the policy response should constitute, first, the Fed going faster in taking its foot off the accelerator, so doing taper faster and a bit of QT and maybe rate hikes. Second, we need to do more on the fiscal side to increase labor force participation, to increase productivity. And then third, we need to be more serious about understanding and supervising probably the non-bank financial sector. That's the elements of a package. It is feasible, it just needs implementation will.
Let's set up the following segment.
The quest to solve inflation started in 2015 when the Federal Reserve started making gradual interest rate hikes up until 2018. The rates went from near zero to about 2.5% by the end of 2018, and you're probably wondering why this matters. Well, the mini rate hikes in 2018 caused a mini recession, with the S&P 500 correcting 7% with the first hike and then 18% by the end of 2018. The situation deteriorated so quickly that Powell was forced to go back to being dovish, and as luck would have it, just 2 years down the line, the pandemic coincided with the rate cuts, due to which the Federal Reserve had enough reason to execute stimulus after stimulus by bringing down interest rates into the ground. This goes to say that even the slightest movement in interest rates is strong enough to shake the economy and trigger a bloodbath on Wall Street. Now this brings us back to Mohammed's analysis. According to him, volatility is here to stay no matter what the Fed does. The year 2020 will be a test for the country when predictable injections come to a screeching halt and the common man needs to go back to reassessing his decisions because macroeconomic conditions aren't as comfortable as they used to be. Any rational analyst would back Mohammed's beliefs on what lies ahead of us, but let's not forget that we're still in a pandemic. It's been 2 years of unprecedented uncertainty with the health crisis, a crunched labour market, deteriorating international relations with China, and now the same in Eastern Europe. I personally feel that if the Federal Reserve does implement rate hikes and feels that the market isn't able to sustain the tightened monetary policy, they will concede and double down on bringing down rates and quantitative easing all over again, a situation which is ideal for the White House because it will make the crowds happy once more. Jerome Powell is stuck in a situation where if he tightens monetary policy, he's going to essentially punch the US economy and the markets in the gut. But if he doesn't, the US dollar is going to be corroded away by inflation. Now I think that it's not unlikely that he will choose to go with the latter of those two options. With new variants of COVID, we never know how things will actually pan out. As for businesses, there's no way in hell they'd ever want access to capital to become more expensive. The choice Jerome Powell faces today is that he could either get bold and nip inflation in the bud now, or he could simply pass this burden onto the future, push it on, out of his way, and allow for some other poor sod the opportunity to try and fix his failings. Now that is it for the day, guys. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up. You don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.